The UK's Labour Party gets the majority that it was dreaming of. Marine Le Pen's national rally in France is expected to give in to the political games where other political parties will prevent them from winning a parliamentary majority this weekend. The euro and pound sterling are strong this morning. The US dollar is softer as investors' attention will be shifting to the US jobs data before the weekly closing bell. So, happy Friday and welcome to Swissquote's Daily Market Talk. And voila, the UK's Labour Party makes the headlines since yesterday with this highly anticipated landslide victory in the general election, which brought them, around 400 seats right now in the parliament according to the latest results, and the number of seats are mounting to reach around 410, while Conservatives got around 100 and something seats at the time of shooting the video, down from 365 secured in 2019. Wow, cable is upbeat near 127.70 and the FTSE futures are pointing at a positive start to today's session. Now, with the election behind us and more political uncertainty and hopefully less political scandals ahead, the UK's Labour win is seen as being a net positive for the British pound and the British stocks. So cable fell from near 1.50 pre-Brexit to almost parity at the peak of the Tory disillusion with Liz Truss mini budget crisis, remember? The changing government gives hope today that at least a part of this recent weakness could be recovered. For stocks, while the small and medium-sized British stocks are expected to perform stronger than their FTSE 100 peers, which are more exposed to the global economic dynamics because the FTSE 100 index is highly concentrated in energy and mining stocks. But both small, big and medium size British stocks should see the benefits of the upcoming rate cut from the Bank of England and additionally the other major central banks into this year's end and the beginning of next year. So the FTSE 100 index was up by 0.86% at yesterday's trading session on Labour victory vibes and should easily throw itself above the 50-day moving average before the weekly closing bell. What a week in the UK. Now in France, the situation looks better from a market perspective as well when looking in the politics. The latest polls actually suggest that Marine Le Pen's National Rally Party could fall well short of a majority at this weekend's second and final tour of legislative election. It's said that the party is forecasted to win between 190 to 250 seats out of 577, which will leave it significantly below the 289 majority needed to pass bills easily. So, the French who voted for Le Pen will probably not see their taxes lowered anytime soon, and investors will hopefully not see the French debt levels explode irresponsibly following the chaotic snap election parenthesis in France. So there will probably be nothing to see here on Monday. This is why investors are now in a hurry to return to French assets and to the euro as well at discounted prices, not to miss the post-election rally that we might see next Monday. So the spread between the German and French 10-year yield fell below the 70 level from last week's peak of 86. The French CAC 40 jumped past its 200-day moving average at yesterday's trading session and is testing a major Fibonacci level to the upside before the weekly closing bell. Now, the index remains well below the 8,000 mark where it was trading when the French President Emmanuel Macron announced the snap election a few weeks earlier. It will probably shrug off the election fear and the election sell-off with a further recovery, but in the medium run, a hung government in France will prevent the French from moving forward with any reforms. So that's positive, obviously, when you think of all the tax cuts that National Rally was promising the French people, but that's not necessarily a net positive for the long-term growth perspectives, as other reforms that could help growth will also be blocked. Just saying. But anyway, the euro dollar extends gains this morning past the 108.20 level. And given the fear of missing out a post-election rally in the euro, well, we might actually see further gains in the single currency before the weekly closing bell. Now, of course, the trading today will also be highly impacted by a set of very important economic data released from the US, which will be back in force from the July 4th holiday. The US will actually be revealing its latest jobs figures today, and the Federal Reserve, those are waiting in ambush to further boost their interest rate cut bets if all goes according to the plan. So the US economy is expected to have added around 190,000 new non-farm jobs in June. So that's down from 272,000 printed a month earlier, which had yet come just as another positive surprise in the series of positive surprises since the year began, mind you. And the wages growth in the US is seen weaker. So a weaker than expected set of jobs data today from the US should further fuel the Federal Reserve's rate cut bets, weigh on the US yields and on the US dollar, while a positive surprise should get the Federal Reserve those to scale back their interest rate cut bets for the Fed that have been rising lately, mind you, thanks to a set of soft economic data from the US and also dovish Fed comments. So the latter, a stronger set of data, should throw a floor under the US yields and back the US dollar. The US dollar slipped below its 50-day moving average level yesterday, and that was on the back of the rising dovish Fed voices, as I said, and also a political-led rebound in the euro and in the British pound. The US dollar index is getting ready right now to test the 105 support to the downside. Now note that the major support here to this year's bullish trend is at a distant 104.20 level in the US dollar index, meaning that the US dollar has room to soften if the economic data, if the jobs data today satisfies the Federal Reserve dose. For equities, well, a soft data, if not too soft, well, wouldn't be bad, mind you. The thing is, well, the major US indices do not really reflect, not even a little bit, the underlying economic dynamics right now in the US or elsewhere. They're mostly decoupled from the economic reality of high inflation and slowing economic growth. The only thing that matters right now in the equity market, especially for the major indices, is the strength of appetite for technology stocks, and that remains very, very strong and is also supported by this expectation of upcoming interest rate cuts. Because look, TSM just hit the 1,000 psychological mark this week in Taiwan for the very first time in history, after more than doubling its stock price since the beginning of last year when the AI craze had begun. Its best buddy Nvidia in the US, on the other hand, is responsible for a whopping 30% of gains that the S&P 500 printed this year. While in Europe, the Dutch ASML, which produces machines to make these powerful AI chips, has accounted for around 38% of the gains of the Stoxx 50 index this year. As such, a chart from Bloomberg shows how the correlations between the stocks in the US and in the European markets have never been this low since more than a decade. This is alarming, guys, mind you, because the lower the correlation, the lower the diversification within these indices, and the lower the diversification, while the higher the risk of a sudden and a sharp downturn. The question is, when? The answer is, I don't know. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.